Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Sonia and Prashant. Sonia, hi, good morning. It looks like the Monday blues has become a bit of a norm for the market. Last Monday, remember, we had that massive down day for the market, and as things stand, it looks like we are in for another similar eerie sort of start Monday morning. The US market, of course, nervous ahead of that May 4 Fed meet. We'll discuss all of that. But Nasdaq is all set to break its 52-week lows, the March lows, and that can be really troubling for the market. Back home, of course, there's something to counter it, which is the ICICI Bank numbers. And ICICI Bank was actually quite weak on Friday. So can it sort of counter the negative trend? Can it sort of fight for the bulls? Because a lot of analysts believe that ICICI Bank is what HDFC Bank was for the market 3 years back. So that could be interesting. But the SGX Nifty is telling us that the overarching theme perhaps could be the global cues. It's down 260 points right now. Sonia, hi.
Absolutely. Hi, Anuj. Morning and morning, Prashant. It's not a small fall, right? I mean, 260 points is going to be a deep fall this morning. So bulls have got to reckon with that, I guess. And it's not just come out of nowhere. I mean, it's the third straight weekly loss that we've seen across the US markets as well. Of course, the sell-off exacerbated on Friday. So the Dow was down almost 1,000 points on Friday as well. Asia's not spared this morning either. So let's see if ICICI Bank's numbers can offset some part of the fall or not. The FII outflow was not that bad. I mean, there was still a sell figure of around 2,400 crores, but we are used to worse. So in that sense, it was relatively just about all right. The DII's buying was about 1,600 crores. So Anuj, that's the big question, right? This is a market that has sort of moved into a sell-on rally situation. There's a downtrend that's playing out. But can the positive rub-off of ICICI Bank offset the fall that we could see today?
Oh, unlikely, Sonia, because look, when the markets get into macro sort of move, any kind of macro move will trump micro move. It's as simple as that. ICICI Bank, for all you care, could be up 5% or 6%. That won't matter because, the global equities, they are in some kind of a bearish phase, have been, except for a few rallies here or there, which have been counter-trend rallies. Though I must add that Indian market has actually been quite resilient because a lot of markets are back to March lows. The Indian market is well above the March lows. The other problem for the market is the FI selling, which is back in both cash and futures. I think if you're a day trader, this market, perhaps the level that you want to watch out for are the Tuesday lows and close. Tuesday, remember, was the day when the market had collapsed and then had some recovery, and then Wednesday and Thursday were good days. So Tuesday low 16,824 and closing low 16,958. And these are the two levels to defend, both on intraday basis and on closing basis. The problem for the market is Bank Nifty, which was looking like a stronger index, has turned weak and in fact had a monthly low on closing, which is very negative, and large part of that is because of selling in HDFC Bank, and even HDFC is seeing quite a bit of selling. IT as a space is not helping because of the valuation derating. So really, it's down to two stocks: Reliance, which has been doing the bulk of heavy lifting for the bulls, and ICICI Bank. Can they sort of prevent the market from falling big? Let's see. Let's hope for the bulls that happens. But the global picture right now is looking a bit too murky. Prashant, hi, good morning.
Good morning, guys. I mean, and I'm going to focus on that, the global picture, and how are things looking as we come into this new week, right? And I think to do that, we need to pick up from where we left off on Friday close and then bring in elements of what happened over the weekend and what's happening this morning as well. So risk assets, as Anuj and Sonia described, are clearly under pressure. There's no doubt about it. And this is true last week as well. So we saw a big sell-off on Wall Street on Friday. The S&P was down 2.7%, but for the week, which is Friday to Friday, the S&P was down by a similar amount, 2.7% or so. The bigger cut, and I think this has gotten largely not unnoticed, but it's because we've been talking about interest rate hikes in the US, this has been in the background. But I think with Fed officials now going into the blackout period, this takes center stage. I'm talking about China. The bigger cut in terms of stocks, equities has happened in Chinese stocks, 4% plus last week. You look at the Chinese currency, it's sold off 2%, 2.3% last week. That's big. This is against the dollar. This morning as well, it's starting lower. This is all linked to slower Chinese growth. Concerns around what happens in Q1, what happens if they'll be able to pick up growth later. There is also a fair bit of disappointment over the amount of policy support provided so far. So we got that small 25 basis point cut in reserve ratio, but we've not seen very much else. We've seen limited intervention in currency markets, etc., from the central bank in China. This is showing up in sort of demand worries. It's weighing on commodity prices. I mean, actually, you look at iron ore prices in Singapore this morning, they're down about 11.5% the last I checked. And I think you've got other commodities, nickel, aluminum, zinc, etc., in Chinese exchanges, which are sharply lower as well. So actually, both energy and metals, they lost last week. Friday to Friday. The other dominant theme, of course, which isn't going to go anywhere, is yields in both nominal and real in both US and Europe rising due to hawkish Fed and now lately hawkish ECB as well. So consider this, front-end rates are broadly being repriced. So the 2-year, for example, has in the US has risen to its highest since late 2018. It stands at about 2.6%. This is the 2-year absolute front end. In Europe, the 2-year yield is at about 0.28. That's the highest since mid-2013. And of course, what happens when you have a mix of risk-off and higher US yields? It pushes the dollar higher. So the dollar index last week ended above the 101 mark. There is no, I mean, you know, at some point it'll get overbought and technically we may see a little bit of a shakeout, but the environment is pretty dollar supportive at this point in time. So, I mean, we clearly have a risk-off tone as we start, and I think it's all macro, it's all global, which is weighing. SGX Nifty is down about 260 odd points, and we kind of start deeply in the red. This will overweigh, I mean, results and everything else, which of course, as Anuj pointed out, from ICICI at least has been a spark of positive. Sonia.
And I was just checking, you know, I mean, ICICI Bank has what, about 6% weightage on the index.
Yes.
So it can't really do much even if it tries, right? In any case, numbers are good. A lot of brokerages, Credit Suisse has raised their target price and earnings estimates on the stock as well. We'll talk about that in greater detail. In the meantime, there are a lot of results that come through this week. So let's get that plate up for you very quickly. It's an earnings-heavy week. We have the likes of Bajaj Finance, Bajaj Auto, HUL. We wrap it up with Maruti and Ultratech Cement on Friday. So lots to talk about this week. On that note, let's kickstart the show and get you some opinion on the equities front. Amish Shah of Bank of America Securities says they reiterate their strategy skew of underweight in consumer sector, which with high inflation is likely to see a demand destruction and margin pressures. With real estate demand still going strong, their fundamental analysts highlight buy ratings on Lodha, DLF and Prestige Estates and Real Estate, ICICI Bank, LIC Housing Finance and Housing Financials, and M&M and Maruti in autos, with increasing work from office and passenger vehicle recovery.
Okay, and we have one more call. Pankaj Chowcharia of Antique says that Indian equity market has been quite resilient, outperforming both emerging and developed markets over the last 1 month. However, they believe that the market may undergo a time correction as we face multiple macro headwinds. Empirical analysts suggest that portfolio with high growth, margin improvement, return on equity improvement and high valuation outperforms during an increasing interest rate cycle, which we are going through right now, of course.
Okay, it's also important to track what's happening in the money markets. The rupee has been rather weak, 76.30 to the dollar, 76.48 actually is where it's closed on Friday. Here's what you can expect for the day. B. Prasanna of ICICI Bank says continued dollar strength backed by hardening global yield, elevated commodity prices due to geopolitical tensions are creating headwinds for the rupee. Sharp depreciation might be defended by the RBI as a strategy to control imported inflation. He expects the rupee to trade in a range of 75.25 to 77.75. All right, that's a pretty broad range in the near term.
Yeah, that's a massive range. On the bonds, B. Prasanna says that hawkish